Welcome to your first class, and I mean that literally. This video is your complete beginner's guide to forex trading. Every term you've been confused by pips, take profit, stop loss, area of interest, order blocks, we're covering all of it. Get your notes out, and if you're watching this somewhere you can't pause, stop, come back when you can, because you're going to want to write this down. Let's get into it. Most traders lose, and I mean most, like 70 to 80% consistently blow their accounts. And if you ask them why, they'll say the market is rigged, or their broker hunted their stop loss, or they had bad luck. It wasn't bad luck, it was no plan. I know because I was one of those traders. I would open the 5-minute chart, see a candle shoot up, think, okay, we're going up, buy, and immediately, almost like the market was personally offended by me, it would reverse every single time. Then I found top down analysis, and I genuinely don't know where I'd be without it. So today I'm teaching you the whole thing from zero, no gatekeeping. And before we go any further, I'll be straight with you. This is not the most attractive video you'll find on Forex. There's no Lambo in the thumbnail, so no, I made $10,000 in a day story. If that's what you're looking for, this isn't your video. Genuinely, no hard feelings, click off. This video is only for the people who are willing to sit down, take notes, and actually put in the work. If that's you, let's go. Before we get into strategy, there are three foundational things you need to understand. These aren't exciting, but skipping them is exactly where most beginners feel lost and why they open their first broker platform and instantly quit. So we are covering them now. The forex market runs 24 hours a day, 5 days a week, but not all hours are equal. The market is split into three major sessions, and where you are in the world determines which ones are the most relevant to you. The Tokyo session opens first. The Asian session is generally quieter, lower volume, smaller moves. Then comes the London session. This is where things start moving. London is the largest forex trading hub in the world. Where London opens, volume spikes, spreads tighten, and real moves start forming. Pay attention. Then the New York session opens, and for a few hours, London and New York overlap. The overlap roughly 8 a.m. to 12 p.m. EST is the most volatile and most liquid period in the entire trading day. The biggest moves happen here. The most setups trigger here. If you can only trade one window, trade the London New York overlap. Why does this matter? Because entering a trade at 3 a.m. when nothing is moving is very different from entering during peak session hours when institutions are actively placing orders. Timing is part of the edge. I usually take my trades pre-London session or in London session before the overlap to New York session has begun, so I can see my trades hitting profit in the shortest time possible. Pips. You'll hear this word constantly, so let's kill the confusion right now. A pip is the simple unit of measurement for price movement in Forex. It stands for percentage in point. Pips can also be measured in the chart by just holding shift and pressing click, and then you can draw this. And the number right next to the bracket is the pips. For example, here the pips are 143.9. Pips matter because that's how you measure your profit and loss, how you set your take profit and stop loss levels, and how you calculate your risk on a trade. Which brings us to the next point, lot size and the calculator. This one is critical. Please write this down. In Forex, you don't buy one unit of a currency, you buy in lots. A standard lot is 100,000 units of the base currency. That sounds huge, and it is, which is why brokers offer smaller sizes. A mini lot is 10,000 units, a micro lot is 1,000 units. Most beginners start with micro lots. Now, here's where people get themselves in trouble. They open a trade, they have no idea how much they're actually risking per pip. And they either risk way too much or they're confused when their accounts move in ways they didn't expect. This is why I always uses size calculator before entering a trade, not after, before. The way it works is very simple. You put in your account balance, the percentage you're willing to risk. I personally never go above 2% per trade, your stop loss in pips, and your currency pair. The calculator spits out the exact lot size you should use so that if your stop loss gets hit, you only lose that 2%. There are free lot size calculators. I personally use 1xtrade.com. And for example, the current account I'm trading on is $5,000. Risk percentage, I do 2%. Stop loss, I usually stay around 30 pips. And currency, if I'm trading Euro USD, calculate lot size, it will be 0.33 lots. On the side note, if you're trading any other currency like USD CHF, you have to enter the market price for it. For example, if the market price is 0.782, it will calculate 0.60 lot. Before getting into the charts, I also want to say that if you want to invest with your own personal capital, then you can use LQH market. It's a brilliant broker, and if you want to get funded, then you can use gold funded trader. That's personally my opinion. You can use anything you want to. This is just what I recommend to beginners, and I'm not getting sponsored by any, so you guys can really just pick anyone. How to execute a trade on MetaTrader 5. MetaTrader 5 is the most trusted platform for executing trades. You just have to log in with the credentials given by your broker or your funded account here, and then you just have to press on the new order. It's a plus icon on the top right of the screen. After pressing that, you'll come on this screen. You can see that you can select the forex pair you want to trade from this drop down, enter the lot size, enter your stop loss, take profit, and buy or sell according to whatever you're looking for, a short or a long trade. Okay, so first, let me kill a myth. The market is not random. It feels random when you're staring at a 5 or 15-minute chart, watching every move and every little candle twitch. But zoom out and you'll see something completely different. By zooming, I don't mean do this. I mean go to the weekly time frame or any other time frame that's a bit larger. That's how top-down analysis works. The market moves in layers. Banks, institutions, hedge funds, these guys are operating on weekly and daily charts. They're making decisions that take days and weeks to play out. They're not panicking over a single candle. We are, or at least we used to. Top-down analysis is simple in concept. You start from the top, the highest time frame, and work your way down. Higher time frames tell you the direction, lower time frames tell you where to get in. That's literally the whole framework. And the time frames I use are all starred here: a week, a day, 4 hours, 2 hours, 1 hour, 30 minutes, and 15 minutes. I usually stay on the weekly, daily, and hourly, 4 hourly. Direction from the top, entry from the bottom. Write that down. Before we touch a single chart, there's one concept you have to get. If you miss this, nothing else will make sense. Market structure. Price doesn't go straight up, it doesn't go straight down. It zigzags, it pushes up, pulls back, pushes up again. Or it falls, bounces slightly, falls again. That pattern has a name and it tells you everything. When the market is bullish, as you can see right here, it won't go straight up in a line. It will follow a zigzag pattern, creating higher highs and higher lows. Higher highs are points where previous higher highs were broken and where the market has pushed into. Analyze this market from the beginning. As you can see, a higher high and a higher low was created. This was then broken when this level was broken through this trend. This is called a break off structure, or BOS. And then this was broken when this was achieved right here. On the higher time frame, when you discover a weekly higher high and a higher low, you have to look for an area of interest in between this. I'll get more into that later. And if the market is bearish, it will create lower lows and lower highs. This is a lower low, this is the lower high. So when the market breaks, it goes down. And you're looking for sells in a bearish market and buys in a bullish market. For example, this market right here, you can just draw this like this. Where do you think the market is heading? Go ahead, pause it. Just look at the higher highs, higher lows, lower highs, and tell me what you are thinking. And then I'll get into the analysis. So as you can see, this market was initially bullish. It came up, it went down. This is currently the higher low and the higher high. The higher high was broken at this point. Market shifted up, and then you follow this higher high with a higher low. Every new higher high will have a new higher low. And right now the market is bullish as it has not broken this point, these 2 points. This market is bullish on the daily time frame. It can vary on the 4 hour time frame, although it is bullish right now. You can also just switch to a line chart. From here, you can just favorite a candle chart and a line chart. These are the only two charts we'll need. And then look at this. Although it has some structure points that are not very obvious, as you can see here, the market did not shift at all. This was a bullish structure, but it slowed down. That's why the market shows a structure point here, although it is not. So you'll just take this market as one move like this, and then the market has gone down. Right now it's probably creating a new higher low to create a bigger higher high for the market. Before you do anything on a chart, I ask one question: higher highs and higher lows, or lower lows and lower highs? One question. That's the whole analysis. Everything else is just detail. First thing I open is the weekly time frame. This is like the 30,000 foot view. One candle represents an entire week and it takes 5 days to close. Right now, as you can see, it's Tuesday today and 3 days are still left in the market. On this pair right now, look at it. There are higher highs and higher lows. On this pair right now, look at it. Higher highs and higher lows. Every rally gets crushed at a higher level. Every rise goes higher. The weekly is screaming bullish. The big players are buying. So right now I've made one decision. I'm only looking for buys on this pair, not sells. And not maybe sells. I'm looking for buys. The weekly time frame has spoken. Now I drop to the daily time frame. One candle equals a full day. As you can see, 11 hours 29 minutes till the candle closes. Here's what I'm checking. Does the daily agree with the weekly? This matters more than people realize. If the weekly is bearish but the daily is bullish, stop, don't trade. Conflicting time frames mean the market is in transition and nobody really knows what's happening. That's not a setup, that's a coin flip. On this pair, daily confirms higher highs, higher lows, both time frames aligned. Both saying the same thing, two layers of a confirmation before I have even looked for an entry. That's the power of this approach. Now the 4 hour. This is where it gets interesting. This is where I find what is called the AOI, area of interest. An area of interest is a zone where the market made significant decisions, not just once but repeatedly. I need at least three structure points reaching to that same level, three highs getting rejected there, or three lows bouncing from it, or a combination. The more times price has reacted to that zone, the more valid it is. And here's a rule that took me a while to internalize. The higher the time frame the AOI is on, the more weight it carries, and the more respected it is. A zone on the weekly, institutions are watching that level. A zone on the 4 hour or daily, still very significant. A zone in the 5 minute, does not even matter. Think of an area of interest like a wall that keeps appearing in the same place. Every price walks up to it, something happens, either buyers defend it hard or sellers slam it back down. By a minimum of three touches, I mean structure points within this area, which I've discovered, and it should be within the higher high and the higher low, or the lower low or the higher low. For example, this area is 41 pips, which is usually too much for an area of interest. I usually like to keep it around 25 pips. In this AUD CAD, I have discovered two area of interest in the daily time frame. There were none in the weekly time frame. As you can see, there are not enough structure points. In the daily time frame, I've discovered two area of interests. Now, pause the video and try to find those area of interest before I get started on how to find them. Let's get into it. So as you can see, just you have to find the area of interest between the higher high and the higher low, because the market won't take price above it or below it. Therefore, we'll just draw a rectangle and go up, 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 and then we have found three structure points here. 1, 2, 3, 4, 5, 6. Six structure points in this zone in particular. And then we can just move this up, 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 up. And I found another one. 1, 2, and 3. These are two area of interest in the daily time frame. If you couldn't find these structure points, go to your trading view, open any currency you can, and then just try to find area of interest in the daily or the 4 hour time frame, because weekly is particularly hard to find. After finding the area of interest on the higher time frames, go down to the 4 hour time frame and look at when price is in the area of interest and wait for an entry signal towards the market direction. Like we discovered, this market is clearly bullish in all higher time frames. We'll wait for the price to get into the area of interest, break out, retest, wait for an entry signal of an engulfing candle, and then enter long, because we're looking for buys in this market. Right now, we can see the market has a big push to the upside through this daily AOI, and now we're waiting for a retest, right? This, and the market will go up most probably if there's an bullish engulfing candlestick right here. This is a perfect example of an engulfing candlestick, as it engulfs the previous 7 candlesticks all at once. And just drag it below. 1, 2, 3, 4, 5, 6, 7. All the candlesticks engulfed by just one candlestick. That is an engulfing and a beautiful entry signal. But you don't enter on the breakout. You wait for the retest and then you go up. You might lose money on this, as some markets just tend to excel, but mostly they come for a retest, and this is a way safer way and a A plus tier setup for your trading, and a perfect 1 to 2 risk to reward ratio for this. Like this is how if the engulfing is right here, this is how I would place my stop loss and take profit on a 1 to 2 risk to reward ratio, right on the area of interest, as price can go back and reject this area to excel. That is just the basics of an entry signal. One of the best entry signals I have ever seen is a doji with an engulfing and a retest. So let's say this was being retested, the price had already broken through, it had come back to retest, and we see a doji candle. A doji candle is a candle with minimal body and large wicks. Wicks are these places where price has been, but it did not close there. And then an engulfing right after that, and you enter right here if it was a retest. Otherwise, an engulfing also works with a retest. Just wait for the retest, as it is the most crucial thing. Do you need all three? No. Engulfing plus retest is enough to enter, but every additional layer of confirmation you have, the higher quality the trade is. More confirmation means less doubt when you're sitting on the trade. That's the entry. Price taps AOI, bearish engulfing appears, retest happens. This is for a bearish market. This is actually a intraday or a swing trading setup. A lower time frame setup is a scalper who initiates like 15 to 20 trades a day, and they all close in a half an hour to an hour. Let me be real with you for a second. When I started, I lived on the 5 minute chart. I thought the faster the time frame, the more opportunities, more candles, more setups, more trades. What I actually got was more confusion, more losses, more time sitting at my screen wondering why I got stopped out of a sell when the daily chart was screaming bullish the entire time. The 5 minute chart is just noise. It's the market breathing. It moves constantly and it means almost nothing on its own. Higher time frames control what price actually does. Lower time frames just help you pinpoint where you should get in and help you find the entry confirmation, the entry signal. All right, let's bring it all together. Top down analysis is about stacking everything in your favor before you risk a single dollar. This is also known as confluences trading, as you're trading off of multiple confluences and a checklist. Weekly, what's the overall bias? Bullish or bearish? Daily, does it confirm? Are both time frames aligned? 4 hour, where's the AOI? Where will the market likely react? Lower time frame, what's the confirmation? Engulfing, retest, doji. When all the four layers are aligned, you're not guessing, you're not hoping, you're trading with the market, not against it. And that's the difference between consistent traders and everyone else. If this is your first time doing top down analysis and it is actually clicked for you, subscribe. Every week I break down exactly how to trade, real charts, real logic, no indicators, no nonsense. Next week I'm showing you a real losing trade where I ignored every rule I just taught you. I thought I could outsmart the trend. I couldn't, but there's a lot to learn from it, and I'm not going to pretend it didn't happen. I'll see you there.